Hi, welcome to Tales from the Sky Lounge. It's a podcast about business, consulting, and venture investing. We get out there in the world and we talk to people who are making it happen and we get their stories. Guest in the Sky Lounge, Kumar Ampapathini. Hey, Kamar.
Hey, Todd. Good to see you again.
Good to see you. So who are you and what are you working on?
Yeah, I'm a Tech CXO partner. I serve startup companies and growth companies as a fractional CFO. I've been doing that for the past 5 years. Prior to that, I worked in Wall Street, large corporations like Microsoft, Guggenheim Partners, JP Morgan in various finance leadership roles. And prior to that, I got my MBA from University of Chicago. I actually started as a coder in the technology department within Cisco systems. And I studied like computer science because I always was fascinated about building things, the logic and how things work. So naturally, I studied computer science, but eventually made a shift over to finance and business side of it.
Wow. It's so cool.
Yeah.
I'm going to really enjoy this. The people that we bring on that they're on, the successful end of their career, always have this kind of interesting path, right? It's never like just straight through. And you're definitely in that bucket. So I'm excited to hear some of your stories. I don't think you may not know this, but I also have a master's of computer engineering from the University of Florida. So go Gators.
Oh, go Gators. That's good to know.
Yeah. So I wonder
Yeah.
if we saw each other by the French fries down there.
Yeah.
At some
French
point,
fries.
maybe.
Yeah, that's a good architecture. Yes.
Yeah.
Right by the computer science department building. Yeah.
Yes. Yeah. So we'll have to talk about that later offline. But you got into software and you said Cisco.
Yeah.
So Cisco was a complete juggernaut in the data, communications, telecom. You want to talk about that? And then, at what point did you kind of start getting eased over into something else?
Yeah, absolutely. So I did master's in computer science from University of Florida back in 2001. At that time, as you know, the dot-com era, Cisco was one of the top companies, and internet and networking was like everywhere. And Cisco was the leader. So naturally, for me to join Cisco and continue my quest to build the things was a natural choice. So I was at Cisco building things, writing software for them. But one thing I realized, Todd, is that however good the technology might be, and Cisco was very acquisitive in 2021 during the dot-com era. They were acquiring a lot of companies. When you look at why Cisco was acquiring the companies, me as a technology person, I had limited understanding about the business and the finance side of it. So no matter how good the technology is, I felt like the decisions are made by the management or the board based on like the financials, the capital, basically whoever had the capital I got the feeling were controlling the decisions. So I was reading Wall Street Journal, New York Times on the deal terms, but my understanding of the business was limited at that time. So I decided to go to University of Chicago to get my MBA and get like a formal training on finance and business side of it. And I chose Chicago specifically for its quantitative rigor and their reputation for finance and economics discipline. So I went to Chicago in 2004 to 2006. And since then, I worked in investment banking and changed my career into finance.
Okay, yeah. Wow, investment banking and finance. So do you feel like, having a technical background, being a quant, is got to be a huge advantage, right? Do you feel like you got credit for that when you go into investment banking?
Absolutely. I joined Merrill Lynch as an investment banker straight out of business school. I was focused on technology, media, and telecom companies, given my background working in the tech companies. And when you walk into technology company, whether you are doing a valuation of a company, a lot of times the tech companies, especially when the technology is changing so fast, you can see the parallels, dot-com era parallels with the AI. AI technology is changing every day. Similarly, the technology was changing a lot those days. And evaluating a technology company is not just pulling together the financial statements and doing a projection for 5 years. You need to understand the technology, whether it's going to survive in the next 5 years or next 10, 20 years, or somebody can come and disrupt it within the next 1 year. And then the valuation is zero for that company, right? So having the technical background and the finance background definitely helped me. And it also gave me a competitive advantage when I meet the clients, I immediately built the trust with them partly because of my background and the depth of analysis I was able to put together.
Yeah, let's kind of
Yeah,
stay there. You said some interesting things. So back in the early 2000s, all the telecom, you know, lots and lots of money, lots and lots of M&A. It was a hot thing until it wasn't, and then, but things were relatively, as fast as we felt like it was back then, it still took 18 months or 3 years to build an ASIC or two, to get a chip out. And, so it was relatively slow pace compared to what we're seeing today. But it still felt fairly brisk in the pace of M&A and in activity and corporate formation. And today, you said something interesting. How do you value companies? We're seeing, rapid disruption where, you have SaaS and then ChatGPT came in and everything was a ChatGPT wrapper until it wasn't. And then now you
right,
can
right.
like vibe code your way into anything you want. How do we place bets, or like, how do you think about that? Or, how do we value things, and is that kind of maybe part of what's slowing down M&A? Are
Yeah,
people scared, or what are you seeing from your finance
that,
brain side of the world?
that's a very good question, Todd. Let me say by this, being a technologist during one part of my life and being a finance person now, it's a different world in the sense, but they merge. Different world or different thinking in the sense, in the technology, as a pure technology, the best idea wins, the best infrastructure, the best product wins. That's straightforward in a way. But in finance, especially when you're doing the valuation, a lot of deal activity and negotiation that happens with the counterpart, a lot of subjectivity is involved. You might have a great company, but if you don't have good communication skills and a story to tell to the counterparty why this deal makes sense, and you're not able to convince the other party, the deal doesn't happen. So the important thing is having the technology background, having that story, why this makes sense is very important. And the second part, to answer your question, how do you value the companies when the technology is changing so much, right? I think uh, especially in the AI world where you can code and build, you can non-technical people can do vibe coding and build a product. The key thing to differentiate is that you can build a product on your own and try to go to the market versus a you still need an experienced person to think about the cybersecurity, the customer experience, all those things to make a product successful. Uh, Building a product and just minimum viable product and just getting to the market is one thing versus making it really ready for the customer is another thing. You still need an experienced technology person. Like being a finance person, I use Claude, ChatGPT, pretty much all the tools available. But in order to get the best output, I have to ask the right questions and call it like a zero prompting or multiple prompting ways to get the optimal answer. So people can code, vibe code, and build a product, but we need like a experienced technology person to take the product to the next level and make it ready for the customer. So that's what I've been experiencing with a lot of startups and other companies in the AI world.
Yeah. It's
Yeah,
kind of like the fundamentals are still intact, right? You always had to say, hey, our tech is this and your tech is that. And A plus B is probably bigger than, the
right,
sum.
right,
But it doesn't make sense. We cannot buy you if it's not accretive, if you can't
right.
show customers and revenue and, or at least a path to that.
Absolutely. There's a
Yeah.
lot more. You said it very well. There's a lot more to a company than just the product. There's a business aspect, there is a customer aspect of it, marketing piece of it. I've seen a lot of products that are good but were not successful, didn't generate any revenue. The product is just one piece. That's an important piece, but there are a lot more steps to be a successful business.
Yeah. Yeah. And in the telecom days, it was not unheard of to, buy people for engineers, acquihire. I think you're
Right,
seeing
right,
that a little bit, like, what was it called? Open Claw. Then
right,
he get
right.
picked up, and then
Yeah,
now he's got a job,
right,
so
right,
not a venture exit by any stretch,
right.
right? But, we're
Yeah.
still seeing the weird, edge cases. But I think, are you seeing M&A on startups right now? You feel like people are buying or able to exit?
Yep. I'm seeing that in the startup. let me take a step back and talk about how the M&A has changed over the last 3 years to current, and my expectations about what's going to happen in future. So in the past, obviously, SaaS was last 3 years. SaaS, if you have a recurring subscription-based business and steady revenue, and your revenue is growing every year, you get a premium valuation. Uh, with the advancement in AI, one thing I've seen with I served as a fractional CFO for a lot of startup and growth companies. The tide has shifted over the last 1 year. Unless you have some relationship with the artificial intelligence, it has become very hard to convince the investors why they should invest in our company. So a lot of companies, either they're forced or they're naturally thinking to shift into AI native and how to make that product AI intelligent. If a product simply, you use the product and you get an output, that's not good enough. You need something, artificial intelligence to make it even easier. So a lot of my clients made a pivot from like just a SaaS product into integrating artificial intelligence to it, whether building a custom tools to it or integrating into ChatGPT or Claude, etc. That's that's one thing. So the fundraising part, the venture capital and private equity folks, they're also seeing, as you saw, the stock market since the beginning of 2026, the SaaS companies, including like big companies like Adobe, Salesforce, their stock got hit like by more than 30 to 40%. That's just
Mhm.
year to date. We are in March right now, March 2026. Year to date, stocks went down so much. Part of it is that Claude and ChatGPT, if you look at their product releases, they're almost releasing or making an announcement every day, or if not every day, every week they have like a new product or new announcement, compared to the traditional model where you would develop it, test it, and release it every 6 months or every year. AI is moving much faster. So there is that skepticism among investors. Traditional SaaS is not going to survive unless you have some kind of artificial intelligence built into it. That's some kind of skepticism. We'll see how the future will turn out. But AI is real. It's here, and a lot of my clients use AI. I personally use a lot of AI tools. Uh, it's it's not an option anymore. It's a necessity.
Yeah. No, I think that's very true. And I call that the add the sparkle button to your product.
Right,
For
right,
everybody
right,
is like, hey, let's put a button
right.
and put the sparkle icon and then call it AI. I don't think that's
Yeah,
enough anymore. And then,
yeah.
I've seen a lot of leapfrogging actually. So the companies that can start with a clean sheet of paper can go so much faster on with zero infrastructure, but you still have to build that whole business end, right? And then so I think we're seeing a shift back to fundamental blocking and tackling business. Kind of just say it again. The product is no longer the thing, right? It can't get in the way, but you do have to have customers and support and finances and advertising and all the things you always used to. And I think we can apply AI in operational roles, not the product, but to make the business go faster or more, more levered operationally. I think that's a great use for AI.
That's a great point, Todd. In technology, especially when you compare Google versus a startup company, a 10% improvement in productivity for Google, it's a big deal because they have
Hmm.
massive code base and existing product. A 10% improvement is great. They're not going to have 50% productivity overnight and change their code base 50%. That's not going to happen. Whereas a startup that doesn't have a product, they can build from scratch and they can have like a entire product built on software using AI tools. So it's a different thing. And to your point, I've seen a lot of clients using AI to improve their operations, their finance, their human resources, recruiting, pretty much everything. And me being a fractional CFO, I'm at the forefront of it. How to use these AI tools to bring the cost down. And I work with sales teams and CEOs. They focus on the revenue and the sales part of it. Uh, and I help them with the pipeline and the geographic expansion and things like that. But my direct contribution is how do we control the costs uh, so that we can, whatever cost savings we have, we can take that and put it into product and engineering. That's what I'm helping with clients.
Yeah, and I think you're a great person to ask this question too. So I'm starting to see when so with these new operational leverage tools, AI,
Right,
desktop compute,
right,
practical AI, you now are able to go deeper, faster, and more thoroughly, but also it's to the benefit. You make better decisions in finance if you have the context for the whole product or company, to go along with that. So you don't make finance decisions in a vacuum, practically speaking, right? There is a ripple. Same thing with the product, right? So if you just, because you can build a product doesn't mean anybody cares, or if it's going to be the right thing to sell. Do you think that that's going to be something in the future? Our roles are not going to be so siloed. It's going to require horizontal.
Absolutely.
With okay,
Yeah. Go ahead.
and
Go
then
finish your thought. Yeah.
no, and that's just it.
Yeah.
And then what
Okay.
does that look like? And then you know, you and I are we've got a mix of different roles in our
Right.
backgrounds.
Right.
And then a lot of our peers have that. But what do you tell the middle manager at Cisco or Sienna or AT&T today? What does their job look like? They don't have that breadth of skills. Should they go back to
Right.
Chicago for an MBA, or how do we think about this?
Absolutely. That's a very good point, and I see that a lot in the companies that I serve. When you go into a management meeting or a product launch meeting, for example, you'll see folks from engineering, marketing, finance, the CEO, the sales team, everybody. And in that thing, when they talk about like a technology roadmap, being a CFO, if I say, "Oh, I just focus on the numbers," I don't understand anything about the product, so it's not my responsibility. That's not acceptable anymore. Because as a CFO, I have to approve the budget. What are the implications of this technology? Is this technology scalable? Or can it be disrupted? All those things, it's implicit that I understand those things. I have a technology background, master's in computer science, but even if I didn't have that, it's implicitly assumed by the team members that you understand. And with the tools like Claude, ChatGPT, whatever product you are in, marketing product or a cybersecurity product, if you ask Claude to explain a complex topic and in simple terms, it will do a beautiful job. Only thing is you just have to spend the time and get up to speed on the product. So it is very important that all the functional leaders, marketing cannot be just marketing. They have to understand what are the financial implications of it, how much cost or how much money they're spending to acquire the customers, what is their return on investment. These are the questions. Like when I see investors having meetings with the marketing management meetings, they don't ask just marketing questions. They ask a lot of finance questions to marketing folks. What is your return on investment? What is your cost for acquisition? So if a marketing person does not understand other disciplines, they won't be successful. Same thing with me as a finance person. If I don't understand product marketing and other functions, I won't be successful. So everybody has to understand the other people's roles and everything that makes a product successful.
You know, so you're a tech guy. So Amazon was famous for some quirky things in their culture.
Right.
So one of them was, there's going to be a paper. Everybody had to write a 3-page paper, and you don't get
Right.
it in
Right.
advance. And then we all
Right.
get in the room, and they hand it
Right.
to you, and then
Right.
everybody silently heads down, reads the paper, and then we talk about it, right? And then it's like, how weird was that, right? And then now it's almost like that's coming back around, except instead of all the people reading it, all the agents are going to read it. And here's the context for this project, go to market, finance, budget, product, all the things. And so everybody's got like a baseline 5-page or 10-page paper for what we're doing here. You think that that's the way forward? You think that we're going
It,
to see more of that?
it's way forward, and it's getting even more powerful. Before we had AI, everybody used to get them, at least in Amazon, everybody used to get the memo. They would read it, they would ask questions, clarification questions, challenge them. And then if you can defend your proposition, then you get the budget approved, right? Now you take the memo. Let's say you are a marketing person and you get a memo from an engineering person. Here are the product specifications, here is the roadmap, and here is the budget I need. And let's say they send it to everybody and I get it as a CFO. I can upload the document to Claude and ChatGPT and ask, what are some of the financial things I need to know about it? What questions should I ask? Explain this product to me in simple English. Who are the competitors for this product? I can do all my research using Claude or AI tool and prepare my questions in advance. And by the time I go to the meeting, I have pretty much the same knowledge that the person who put it together because of these AI tools. I could be more better prepared. And I think that's the way future. Like expectations are that when you go to the meeting, just don't show up to the meeting. Come prepared, ask the questions, contribute something to the meeting so that it's a successful, productive meeting, and the outcome is what is expected.
And then maybe we I'm just thinking out loud, but maybe some of these agents, we expect the agents to take that first pass because hey, we don't need to say the obvious things, right? Just because you
Right.
don't understand marketing, but
Right.
maybe your agent does, right?
Yes.
Um,
Yes.
yeah, wow, that's very cool. I wonder how many companies are out there thinking like this. I think this is pretty rare, right? From my experience.
It's a very good question. I would have expected a lot of, since AI is so easy to start using it, right? $20 per month is nothing. It's less than a DoorDash, right? Um, right.
Yeah,
So, but
that's pretty.
but
It's like, why isn't everybody use this? This is crazy,
right,
right?
it's one DoorDash versus a monthly of $20, and just imagine the productivity that you get. But you'll be surprised. I would have thought that pretty much everybody is using it, or at least like 70%, 80% of the people are using it. But there was an interesting study from Anthropic, even in functions like finance, legal, or computer science, where you can be a lot more productive and you can automate things like up to 90, 95% of them. Their study shows that only like 20 to 30% is being utilized. And I, I, I'm not sure why, but I have to say that probably one reason is cybersecurity. If I have a client, a startup client, they're like from day one, they start using Cloud Code and start building the product. But if I go and work for a big, large bank, there are a lot of regulations, cybersecurity, all those things. And for them to deploy to, let's say, 100,000 employees at a large financial services company, they have to test it internally, go through, make sure the regulations are there, data controls are there. It could be a 6-month project before the cloud is deployed to everybody in a large organization. So that 6-month gap is there. So I think that 20 to 30% utilization will go up as more and more large organizations will figure out a way to use it faster. But within the startup world where I live and where I serve, I'm seeing close to 90% adoption of AI
Oh,
tools. Yeah.
yeah, and I'm seeing the same thing, right? And then
Right.
the greenfield applications that are SOC 2 free,
Right.
like
Right.
it's easy to go fast early. But
Right.
at the same time, I think you're exactly right. And I think
Right.
Anthropic, particularly in
Right.
OpenAI,
Right.
are both trying to figure out why the heck is, this cost of DoorDash, why the heck is it like everybody's just
Right.
like all over this? And
Right.
then I think I had a couple conversations recently that unlocked that where I think it is the CISO
Right.
in the regulatory
Right.
compliance where,
Right.
hey, it's not, you can't just like turn this on and then throw all your quarterly reporting financials if you're a public company through this thing and then
Right.
go across a public API,
Right.
where, because that's
Absolutely.
what the desktop things do. And then there's
Yeah.
some weird legal terms and conditions in there too, where, hey, we will train on your data. That's unacceptable. So I think there's some things like that to for the larger, more structured company, more regulated companies to get through. I think that's a big part of it. I think it's going to take 6 months to a year, and then they're going to start, figuring stuff out. But I think these model companies are going to have to change the way they deliver in some interesting
Absolutely.
way.
Absolutely. Absolutely. Like to give you an example, like take JP Morgan as an example. They have a lot more to lose if their customer data is exposed,
Oh yeah, yeah,
right? So as
catastrophic.
opposed to a startup, if they have nothing to, worry about because they have limited customers, or maybe
Yeah,
they have zero customers to start with.
right.
So they can start using AI tools from day one. With JP Morgan, they have to do like proper testing and cybersecurity and make sure every data is secure before they can launch this. So
Yeah,
it's a natural progression.
and you have to have audit
Yeah.
logs and a bunch of stuff that's
Right.
boring and hard to
Right.
implement, and then we just don't have the tooling yet. But I think there's a lot of entrepreneurs out there hitting it all this stuff. So it's
Yeah.
it's not going to take very long. Well,
Right. Right.
so let me ask you a spicy question. So you've been in a room when billion-dollar decisions get made in your banking career. The highest levels of finance. What do startup founders fundamentally don't understand about how institutional money thinks?
Yeah, that's a good point. I think the startup founders, they have high energy, they're risk takers, and they think that if the product is good, the capital will follow. Uh, it depends on the product. The story is partly true there. The profit, the 90% of the founders that I work with, Todd, for them, the revenue comes first, growth, risky strategy, growth any cost. Profitability will comes much later. If they run out of cash, they'll go do another round, Series A, Series B, whatever series they want to do. That's the mentality. Whereas institutional capital, they're very calculated because they're managing LPs funds, other people's money. They have to see not necessarily the profits today, but some pathway to the profitability. If there is no profitability within the next 2 years, then for them it's very risky. If the profits come 5 years later, most likely they won't invest. But if you can show the founders can show a path to profitability within 2 years, then it's relatively easy to raise capital. That's
And
the
it,
mentality I've seen.
yeah, and it's
Yeah,
the PE or the institutional investors. It's like we will invest for you to go a little 10% faster in a deficit spend, but as soon as we panic, that can come off, right? And we're not going to do that anymore. But you have to maintain profitability. Is that
the
and
the
then
profitability, yeah, and it depends on the product. If the product is really good and they have a lot of customers and it's a matter of time before they get profitable, then that's fine. But you don't have customers, you don't have, you just have product, but you don't have any customers and you don't have path to profitability. A lot of institutional investors, it's too risky for them.
let's go back to that VC model, right? So the VC model you asserted for startup founders,
Right. Yeah.
is I think we need to challenge that model a little bit where you deficit spend, put light a bonfire on the pile of cash, just go
Right.
like hell, acquire
Right.
customers, and we'll figure it out later.
Right.
I kind of think that was that was good in an era where getting a product out faster was important, right? 6 months in half
Yeah.
a million dollars was better than 12 months and $1 million. Um, in an era where it's so fast and so cheap to get out of the gate, how does that equate? Has that equation change now? Does what we invest in change? Does the model, the financing of the bootstrap, so to speak, change? And then where do the milestones change?
I think with the AI, you can get the product built really quickly, but unless the product is really good, you still have the same problems of acquiring the customers. You have the marketing. How do you make it available, or bring awareness to the people? All those things, the legal, financial aspects of those things. So with the AI tools, one thing is everybody talks about building the product and getting to the market. There'll also be a lot of competition because a lot more people are capable of building the tools by themselves, and you'll see a lot more products in the market. The one that's successful, and you probably know, uh, in the technology world, usually the top one or two where people focus. If I search on Google and find the top two products, why would I go and pick a 10th product? You might be the 10th best product, but nobody goes for you, right? It has to be top one or two. So I see that there'll be a lot more competition. And I think faster to market is okay, one aspect of it, but most important thing is how is the customer experience, the security aspect of it, all the other things that are more important for it to be, successful, and people will start using it.
So would you rather, and I suspect you probably do angel investing and, maybe take a little equity for your time like I do. So would you rather see a company that's got really great technical founders that can build anything you want? It's really solid product, but questionable go to market.
Mm.
Um, we'll figure it out, right? We'll
Right,
hire a
right,
salesperson
right,
later,
right,
right?
right.
Or would you rather back a bunch of mid-career business type people that have no idea how to build something, but have friends and understand the problem and can get it at least a couple people to go use it? Which one of those two would you go for at this point in time?
It's a good question. My answer is going to be depends on the founder.
Mhm.
A strong, really driven founder can make the difference, whether it's a technical debt that you have or a marketing or business gaps that you have. Like Elon Musk, for example, right? He makes the difference. The companies that he runs, he makes the difference. So there are some companies where the founder makes the difference. If
Mhm.
the founder is driven, the senior management is driven, whatever gaps that you see currently, they can be overcome. You can hire people, smart people, etc. But if the leadership is weak, uh, and they can hire smart people and they don't know how to manage, I haven't seen, if the founders are weak, I haven't seen the product very successful. But if the founder is strong, very driven, hardworking, and have like a Elon Musk kind of mentality, like I will do whatever it takes to build it and make it successful, risk taker kind of thing, then whatever obstacles and the gaps they might have, they will overcome. Yeah.
So I've kind of been thinking through this, right? What's changing now that we can get products faster in the market? Products
Right.
not as big a deal as it used to be,
Right.
but maybe it's all going back to fundamentals, right? And then the tide is going out. We're seeing who's going to swim naked, but it always has been about the founding team, right? So
Right. Right. Yep.
you really did always need that business founder. It's just more critical now, and you're exposed if you don't have it. You can't have a better mousetrap and exist for 18 months without selling anything.
Absolutely. And one thing that comes to my mind immediately is the Slack. Slack started as some other product. I don't remember it now, but some other product. It was not successful. They were able to make the pivot and become like a tool now, and it's very successful. They sold, the Salesforce acquired it for like $20 billion, something like that. But its Slack original product was not Slack product. It was something else. So having that founder mindset and able to pivot with the circumstances changing, that's the key. And I think Serena Williams once said she doesn't understand much about technology, but when she invests in technology companies, she looks at the founders. If the founders are great and she's convinced, she would invest in it. There is truth to her statement. Founders are key.
Mm-hmm. I think that's right. You invest in athletic, high energy, high integrity founders, and
Yeah,
watch them
absolutely.
go. And you have to ask a whole lot less questions about what
Yeah,
they're doing.
yeah,
So,
yeah, yeah.
well, and then we live in a time. My kind of investment thesis is everything is compressing now, right? So you're not going to get $1 million or $5 million investment, a seed or pre-seed or whatever we're calling it these days, unless you can show rapid traction, right? So
Right, right.
what? So if somebody can get in the market and get a product almost overnight, and then get a couple beta users within, I don't know, a month, like,
Yeah, right, right, right.
is that unreasonable? And then at what point are you starting to see people get to that? What's the next one? Be like 100,000 monthly, like $1 million annual run rate,
Right,
100,000 a
right.
month run rate.
Yeah,
What's
yeah.
a reasonable? What are you kind of how would you calibrate a founder in a reasonably successful startup? Like, how fast should they be going to be competitive in that angel group pitch off,
Yeah,
to
absolutely.
attract investment?
Yeah, that's a good question, Todd. And I see that in the startup world. The first thing is, it's not just the product, how good it is and how fast you can do it. The founders have to ask yourself, what am I solving here? Is there a market need here? If there are a lot of other products that are serving the purpose, the standards are pretty high for you to develop another product and compete with them and take market share away from them and be the number one. Like Elon Musk, for example, when he started the electric car company, he had to compete with all the traditional companies. The bar was pretty high, and going from zero to gaining 10%, 20% market share, it's pretty hard. Like competing against GMs, Fords, Toyotas of the world. So the bar is high. So if the product is you are serving existing demand and it's not new, the bar is high. But if the product is it's serving an existing need, and there's no other product, uh, then it's easy to raise capital. And even if you are slow, but you are first to the market, it's okay because there's nobody else available, right? Uh, so that's the key thing, what the product is doing, and is it serving an existing demand or not? And then another thing we look at is, and a lot of investors look at, is that what's the addressable market size? Your product might be great, but if the addressable market is like $10 million, right? So why bother? But if the market is like $1 billion or $1 trillion, then it's attractive. As Jensen Wong said, he's working on $1 billion startup, right?
Yeah,
Right?
yeah,
It's
yeah. Trillion, maybe. Yeah,
maybe trillion, right?
yeah,
So when he looks at new technologies, he thinks in billions and trillions. So I think that's one of the things investors look at it. This product, how big can it become? Can it become $1 billion, $1 trillion? Uh, so those are keys.
So we that's a traditional, very traditional view. You got to have $1 billion or better, or probably
Right, right,
multi-billion-dollar total addressable market in order to
right,
get $1 billion valuation. So
right.
the venture portfolio can get their 10x or 100x or whatever from that one company.
That's right.
Um, and then so how that magic milestone of the $1 million run rate, like all of a sudden that unlocks, for whatever reason, it unlocks a lot of traditional investors. What do you think is magic about that? And then how fast should people get there, to be competitive? Or does it even matter, right? You just
Right.
kind of do what you're going to do to get there? Or how
Yeah.
do we think about that milestone in
Yeah,
this day and age?
absolutely. For a company, or for biotech companies, for example, right? I've seen the funding uh, is okay, even if they don't have any revenue. They're working on clinical trials. Phase two is successful. Phase three is almost complete. They have some patents, and if it is successful, it's going to be like $1 billion or multi-billion-dollar product. There are specific investors who would focus only on biotech. They know the risks. They invest in tranches and they know when to exit, when to invest, even on pre-revenue companies. So that's a separate industry within the venture capital and private equity that you can get funding even if you don't have revenue. But for traditional technology companies where you have product and you have subscription-based product, or you know whatever it is, the $1 million magic is that a lot of VCs and private equity firms, especially the institutional angel investors, are different. Friends and family and angel, that's a different, and the amounts are small, usually like less than $1 million or so. But if you want institutional capital, they need to show some revenue. Even $1 million is less for institutional capital, but there are seed investors who can fund if $1 million revenue is sustainable right now. And the most important is, what is your growth trajectory? In Wall Street and in the investment community, there's something called the rule of 40. Like if your revenue growth, profitability, margin combined is 40%, that's pretty attractive. And then you add some more metrics, gross margin and things like that. There's a rule of 100, rule of 140. Wall Street is famous for coming up with all these rules.
Well, that didn't work. Let's do another number.
Right, exactly.
Let's fit the
So,
curve to today, right?
exactly.
Yeah.
But the simple concept is, if you don't have profitability, expectations are you better have at least 25% to 30% year-over-year growth every year for the next 5 years. If you have profitability, that's great. We still want growth. So that's basically what investors look for.
Let me throw something weird out at you and get your reaction. So I think, and I've been doing a lot of thinking about this, the new tooling, and I don't even want to say the label anymore because it's kind of like
Right, right.
sour in my mouth now. So, but with some of this, new capabilities and operational leverage that we have, um, I believe we can get to market more efficiently than we ever have. And then so what, right? And then I think, and then one of the things that's going to happen is, that venture investable, you know,
Right.
marginal rate
Hmm.
is going to come down, right? And then so a lot of companies aren't going to be, I think venture is going to continue to do exactly what you just said,
Right,
right? Go swing
right,
for the fences, go
right,
big or go home.
right,
But I think there's a lot of interesting companies that we used to call lifestyle businesses. Ooh, don't say that, right? But those lifestyle businesses that are, 1 to 5 or maybe 10 million ever,
hmm, right, right, right,
in revenue ever
right.
over 3 to 5 or 7 or 8 years, now become actually kind of attractive, right? And then I wonder if there's, ma and pa, friends, family, and fools, category of investors understand, like, hey, if I go to get a rental house, I get a little coupon every month. I get a little bit of cash back. I wonder if there's kind of a place in the market at that level for some of those lifestyle businesses that are not horrible businesses, but they just haven't been traditionally investable. If we can launch them for 50 or $100,000 all
Okay.
in,
Yeah.
and then they throw off a little cash, are you seeing deals like that, or should we be even thinking about that, or is that just weird? It's like
Yeah.
two.
No, It is true. You'll see a lot of companies who will spring up like that. The reason for that is right back in the day before there was cloud, Amazon Web Services and all. To start a company, you need to have like a data room, IT infrastructure, everything lived on your own servers. And it was a big investment before even you can start a company. With AWS, the startup costs are like close to zero. Like you pay what you use. So that eliminated friction, and we saw a lot of companies getting started much faster. Now with the artificial intelligence coding tools, instead of having like a 10 engineering team members, you probably need like a good 3 to 5 people. You're cut
Maybe, right?
right, maybe
If
maybe
even
maybe
that.
even less, yeah,
Yeah.
even less, right? Especially if the founder is technically strong and they know how to use the tools, maybe you don't even need 5. So the engineering team cost is eliminated or cut drastically. Same thing with marketing and all. Marketing, finance, everything. If the founder is tech savvy or AI savvy, the founder, 1 person team, can do everything. They can do the tools to do the coding, finance, everything, but in the initial stages. But they have to be expertise. They don't have the time, first of all. Right? What's the best, as a founder, what's the best use of your time? Use split between product development, finance, marketing, legal, everything, or just focus on the product, get it to the market, and let the other people take care of it. That's where the fractional CFO model comes into picture. Right? If you want to hire a full-time CFO, they cost 300, 400, 500, even $1 million, depending on the industry and the location. And the founders' number one goal with a limited budget is put everything into the product development. But they still need financial statements. They still need legal advice. The fractional, I serve my clients at like fraction of a cost of what a full-time CFO costs. And I have, as you mentioned at the beginning of the podcast, Todd, I have Wall Street experience. I did billion-dollar deals. I bring all the experience at a fraction of cost to the founders, and it's pretty attractive. So the cost has gone down to start a company and leverage fractional CFO, fractional technology officer, fractional marketing officers, and you can start a company that produces 2 million, 5 million, $10 million pretty easily with very, very little upfront investment.
Hmm. Yeah, and then I was a founder, technical
Right,
founder. Then
right.
I got a Eric Firstad. He's one of Tech CXO partner. He's in our firm. That was the best thing ever, right? Because it was like way better talent than I could afford at exactly the time that I needed it. And then so talk about that journey from banking, right? So you're in Wall Street, Titanville. And then what got you out of that and kind of back to, I think, where you're a lot happier in that startup world. But, how did you go fractional? What was that story that led you to the fractional, which I think is like, an insanely great value for people at the lower end of the development curve.
Yeah, absolutely. I always wanted to be involved with the startup ecosystem since the beginning. But when I graduated from school, from University of Chicago I changed career, as you know, from engineering to finance. When I started my finance career, I started in investment banking and I worked at different corporations. I always wanted to go and help the startup clients, but I was not confident enough that whether I have enough knowledge to help the founders. Because, Todd, as you know, you are a consultant as well, a fractional CTO. When you go to the clients, the expectations are high. They think of you as a problem solver. The client has a problem. You will do the analysis and come up with a solution and help the client to fix the problem. When I had zero experience coming out of school, I was not confident that I had the enough knowledge to help the clients. So after working on Wall Street and large corporations and gaining knowledge, I felt like back in 2020, this is the time to become a consultant. And Tech CXO's model was pretty attractive to me because I get an opportunity to work with multiple clients and on a fractional basis. So multiple founders on a fractional basis. Before I joined TechCXO, I was just focused on financial services, like JP Morgan, Guggenheim, etc., and small tech flavor to it. That's about it. That's the depth of my industry knowledge. Since I joined TechCXO 5 years ago, I worked with healthcare companies, cryptocurrency companies, cybersecurity, technology, you name it, pretty much all the industries. So the bar to understand the industry and help the clients is pretty low in startup companies, because you're focused on a niche product, and you need to understand 100% of it and that particular area where they focus on. So I was able to pick up different industry knowledge and serve the clients. So it's, you said I'm happier. That's very true. I'm happier in the current model, because the energy level that you see working with the startup founders, it's quite different from working in a large company. I mean, large companies are great. It's personal preference for some people. Like, for example, if I ask you, do you like red wine or white wine? What's the right answer? There's no right answer. It's your personal choice, right? For me personally, this is more rewarding, happier, and I feel like I'm contributing more, especially for startup companies. They want to sell their company or get the product to the market. They need the financial budget, and finance CFOs are expensive. With the fractional model, I can give them the attention and the service they need at a fraction of cost. Personally, I get a lot of satisfaction helping out the companies and founders, and it's been a great model. It's been more than 5 years, and I love it.
And you've had some of your clients go on and get acquired, and I don't know if you've had anybody go public yet, but there's a time in that growth curve where you kind of like sit down with the CEO and say, "Hey, man, it's been awesome,
Right.
but you really got to hire somebody full time. I can't do this for y'all. Fractional doesn't make sense." Have you ever had that conversation
It's
with people, or where's that
yeah,
line?
I did. It's not about capability. Most of the, most of my work and also my colleagues, they come from different backgrounds and serving large companies. So they can scale up to a billion, 50 billion, $100 billion companies, fractional CFO, and still serve the company. But I think the time comes where uh, you need a dedicated, let's say you are a public company, you need a dedicated full-time CFO. I serve multiple clients, right? I cannot put 100% of my time on one client. I serve multiple clients. Practically, it's not possible. But a full-time CFO with $1 billion in revenue, they need a dedicated person. So anywhere from pre-revenue to up to 100 to $200 million, I think fractional CFO model still works, because there's still some companies with $100 million of revenue, believe it or not, Todd, they're still not profitable.
Oh man,
So, so you'll be
good God,
surprised.
yeah.
Uh, as long as you have that, where you have whatever budget that you want to put it in engineering, you don't have enough capital for human resources and CFO. You are in the mindset of, let me get the fractional CFO. But I think anything more than 100 to $200 million, you need a full-time CFO. There's a lot of compliance things, a lot of full-time dedication is needed. I can go help them, but I don't have the full 100% time allocated to just one client. I serve multiple clients. So my advice to a lot of my clients is, if you're hitting the $100 million to $200 million, let's go find a full-time. And I interviewed a lot of CFOs, help them, place in the companies. That's the model.
Yeah. Yeah, I've done that too. Private equity, you end up being more interim than
Right,
fractional.
right,
And it's
right.
like, yeah, you'd be better served if I help you find your forever,
Yeah,
CXO.
that's
All
right.
right. I need some more stories. So, the cool thing about
Right,
startups and being with them
right.
for a while is a few of them are going to actually go on to do great things. You got a couple of them you want to share with us, like that were super successful, or maybe even tragic. Uh, you don't
Right,
have to
right,
name names on the tragic ones, but like,
right, right.
let's crow about the successes maybe a little bit.
Yeah, absolutely. I think the most interesting ones, in my CFO work, Todd, there are different work streams. Some clients just need regular budgeting, forecasting, close the books, financial reporting, monthly reporting or quarterly reporting to the board, and things like that. That's the business as usual. The second thing is they want to build a new product, expand to new geographic locations, organic growth. And there's a lot of planning and strategic thinking involved in that. And the third one is the mergers and acquisitions. And especially in the startup company, I represented a lot of clients on the sell side, due diligence, helping with negotiation, contract negotiations, and helping them with the post integration and things like that. And when you ask for stories, always the mergers and acquisitions has the dramatic impact to it, because it's never straightforward, because you're dealing with multiple people. So my most interesting stories are exciting work probably came from the mergers and acquisitions. To give you an example, we closed a Schedulicity transaction to Vagaro back in October 2024. There was a press release, all that stuff. But before the October 18th mark, there was a lot of work that went into it. Getting the financials ready. Like the first thing that when I joined as a CFO, first thing I do is clean up the financial statements. A lot of founder-led companies, usually the founder with no finance knowledge is responsible for financial reports or entering data into QuickBooks or any accounting software. And it's good enough when the company is small, but once you get into like getting the funding from institutional investors, the first thing institutional investors is send me the financial statements. And the
Hmm.
founder says, oh gosh, I don't have financial statements. I need to hire a fractional CFO, help put together the financials so I can get the funding,
Here's my
right?
shoebox, right?
Yeah.
Like Michael Dell.
Exactly. So, so the first thing I did when I joined Schedulicity was to take an assessment of how good are the financial statements. Have they been audited? Are they ready for sale process and things like that? So that took some time to make sure that you get from point A to point B in terms of financial cleanliness. And the second thing is audit. Sometimes audit is required for a transaction, but a lot of buyers and sellers these days, they do something called quality of earnings. They basically look at the financials, they sanitize or clean the data and make sure that there are, one-time items, one-time revenue, one-time expenses, those are all normalized. So in a steady state, what would the revenue look like? What would the expenses and profitability look like? That's what basically the quality of earnings does on a steady state. So I did that with Schedulicity. And then obviously in a financial transaction, the interesting part is the negotiation and working with the counterparty, right? All the things I've mentioned so far, the financial diligence, the financial cleanliness, the audit, quality of earnings, it's all something that you can control internally, and it goes as expected. But then once you get into potential buyers, you work with multiple buyers, you work with an investment banker who facilitates the process, and then one person might say, I'll pay you $100 million for this. Another person, buyer might say $150. Another one would say 125. The one that bid $150 million would ask for exclusivity. I don't want to negotiate other buyers in the data room. I want to work with you exclusively. Then as a seller and as an advisor to the seller, as a CFO, I have to make a decision. Is the person that's bidding $150 million, is that real? If we go exclusive with that person, because all the bids that they submitted so far, they're not binding, meaning like they can just walk away, right? If we go exclusive with them, and then for some reason they don't have the funding, they don't have the bank loans to close the transaction, they walk away, then we're back to square one, right? So there's a lot of art and science of evaluating not just the numbers, but the quality of the buyers who are going to who are bidding, whether they have the financial resources to buy the company, and how are they going to treat the employees, right? If they acquire the company and fire 90% of the employees, how does it look for the morale of the company? Like founders are very particular about that, right? They built this legacy company for last 30 to 50 years. They want to retire now, and they want the company name, brand, culture to survive even after the acquisition. So there are a lot of qualitative factors that go into a sale process, not just numbers and valuation, employee treatment, culture, uh, how the company will survive after that. A lot of those factors go into it. It's a good discussion that we have, and when we go into war rooms for the acquisition and things like that, it's pretty interesting.
Hmm.
That's
So,
yeah, that's the most exciting part of my business.
so it kind of turns into a people
Yeah,
problem, and then
right.
you're playing poker at some point, which is
Yes,
kind of a sales skill.
right, right.
Very cool. So, of all these companies you've served, is there one that you would write a movie about, and then that's kind of like an exciting, thriller, or maybe like a very exciting,
I
underdog story?
I think my job as a CFO, my goal is to minimize whatever drama we have, because
Yeah,
one thing I
yeah, for sure.
noticed, Todd, is it's not necessarily the highest bidder or company with the financial resources that's going to acquire the company. It's usually the person or the company that's calm, ability to work with the company. maintains the culture, those things. Usually, the less drama, the better. Just because somebody has a lot of drama and the loudest voice in the room doesn't necessarily win the negotiation or the deal. So one thing that so as a CFO, my goal is to make sure there are whatever heated discussions that we have, uh, we make sure we take the time out and we control that communication so the drama doesn't happen. But to answer your question about which one would be which movie, I think the movie is, for example, Barbarians at the Gate. That's one of the best movies I can think of in terms of a Wall Street deal drama. Nothing comes to mind to that extent. Uh, but usually the M&A deals will be good candidates for if you want to make a movie. Usually M&A deals are the good candidates.
Let's talk about the future here for the next couple
Yeah.
minutes.
Yeah.
What we tell the next generation is kind of important and also a little bit uncertain now. How do you think about that? If you have a young Kamar coming out of CS school, what would you advise? Maybe a CS fresh out, and then maybe a fresh out MBA. How do
Right.
you position yourself for
Yeah.
the future?
Absolutely. I think number one skill, whether you are a technology person or a marketing person or a finance person, whatever it is, number one skill I would recommend is the communication skills.
Hmm.
Whatever courses you need to take at Dale Carnegie or YouTube videos or in-person meetings, Toastmasters, whatever it is, if you can't communicate in a business world, you are ignored. Deals don't happen. Nothing happens without proper communication skills. So, as a young person coming out of school, focus on improving your communication skills and get good at communicate. And you'll be dealing with the different people. One person with a short temper, anger management, one pleasant person. You can't control who you're dealing with, but you can control yourself, how you react to that person. And trust me, in my 25 to 30-year career, I've seen a lot of people. So that's number one skill I would recommend. Number two, be very, very tech savvy in the cells. There's no excuse for you to become proficient in AI tools. Whatever discipline you are, legal, marketing, finance, technology, whatever it is, you can improve your job on technology. Whatever routine jobs that you can do, automate it using AI tools so that 50% of your time is done by the automation. The remaining 50% where you can add value, whether it's a product iteration, like you should be obsessed about the things that matter. Refining the product, like Steve Jobs, for example, he was not satisfied with the first prototype of iPhone, right? I don't have the exact number. I'm sure it went through like hundreds of iterations, right? That's where you need to spend your time, whether it's a technology product or finance or whatever it is. Wherever you are adding value, that's where you focus. But automate everything that's non-added value using technology, etc. And then the third thing I would say is read. When I was at Cisco, my knowledge was pretty limited in finance, business, even technology. Fresh out of school, you only have so much knowledge. Subscribe to Wall Street Journal, New York Times, the technology trade magazines or marketing trade magazines. Subscribe to newsletters, whatever it is. If you're not spending at least 1 or 2 hours reading about improving your knowledge in your own field and in the adjacent areas, you're not going anyway. I've seen like a lot of fresh graduates who are a lot more tech savvy, especially using AI tools, like summer interns or fresh graduates in my startup company start. Compare that to, you know, old timers who are basically coasting, who don't have appetite to learn the tools. And you can see the difference in productivity and what they can do. So read, develop the skills, communication, improve the communication skills. These are basic, but they have a huge impact on your career over a long period of time.
Well, it's all about getting out there in the world and talking to people and making things happen.
Right,
Do you got any
right.
great travel stories you want to share with us?
Well, travel stories, it's part of my life as a fractional CFO. I travel to the client sites, and it's part of my life. So it's a strategy for me to have like a good travel and also be productive. Like I could be going into a board meeting and my flight just landed like 30 minutes before, right? I need to be like, I think about myself as a corporate athlete, right? When you see an Olympian, they're like at the peak of their performance. whether it's a 100-meter run or a 500-meter run, you have to be in top shape. Like for me, when I attend a board meeting, I have to be like a corporate athlete. So in order to do that, I develop some simple tips like making sure that I get proper sleep. The sleep is probably the most underrated thing I've seen among like a lot of corporate people. Some people I've seen like they're proud of, oh, I sleep only 3 hours a day. I I used to think, wow, how can he do that? He must be like amazing. I used to be jealous of that. Now, if somebody says they can only sleep 3 hours, I think they're ignorant and they're fools. So they're not focusing on the health and the long-term impacts of the sleep. So get proper sleep. Make sure when you're traveling, you pack some electrolytes and you are properly hydrated. And simple things like if you get a business grade business class upgrade or economy plus for like a small amount of dollars, it makes a huge difference.
Totally
Uh,
worth it.
Absolutely, totally worth it. You get additional time when you're comfortable in the plane. That's your working time. And when you are a consultant, usually you go by hours. Every hour is your billable hours. And if you're able to work in the plane and you still have the energy while you're traveling, that's the key. So that's part of my strategy to optimize my travel. In terms of interesting travel stories, not much to share other than I try to, when I travel, especially the airport food, I stick to my routine.
Okay.
Couple of times where I experimented and went for the local specialty, I had food poisoning or whatever it is, right? So I stick to whatever it is.
Yeah.
Whether it's a burger or a pizza or whatever it is, I stick to the routine. So I know what I'm getting, and there are no surprises. It's if it is business as usual when I travel, that's a great outcome for me. If there are surprises, usually they are negative surprises.
Favorite or least favorite airport?
Well, favorite for me is I live in Princeton, New Jersey. Newark Airport is decent. Uh, the other airports, it's hard to compare because I don't spend much time. I fly out of Newark most of the time. Newark and United are my favorites. Luckily for me, United has been decent. Philadelphia is equal distance to me, but I don't prefer Philadelphia. American Airlines, the reputation, even before that, US Airways, worst reputation. So I try to avoid that, but Newark and United has been good to me.
All right. Well,
Yeah,
Kumar, it's been great having you here in the Sky Lounge. And how can people follow up with you after this on the internet if they want to get in touch with you?
absolutely. And that's, I put an effort to help out younger generation because when I was younger, I was always looking for who can I reach out to, who can mentor me, things like that. And younger people, if they want looking for mentorship or advice or anything, the best way to reach me is LinkedIn. Uh, Send me a brief note. That way I know exactly your background and what you're looking for. Do not text me. Sometimes they could hold up my phone number and they text me
Yeah.
and ask for, can you introduce me to this person? First of all, who are you? Who is this person? I don't know. Email is the best way. Then connect with me on LinkedIn and email me with all the details. If the person is not putting the effort and ask for a favor, that seems superficial to me. But if the person is putting an effort and a genuine request, I take, I go out of my way to help those people.
Absolutely. Well, thanks, Kumar. Been great having you.
Thank you, Todd. It's great pleasure talking to you.
Bye for now.
Thanks for joining us in the Sky Lounge. Please like and subscribe to hear more from Tales from the Sky Lounge here and anywhere else you get your podcasts.